Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. If you guys are looking for undervalued investment opportunities, click subscribe. Love to have you on the channel. And today I'm going to go over a lot of real estate, we'll call it data. I consider them facts, data, and I want to share a lot of this stuff so you guys know what the heck's going on. There is a lot of misinformation on YouTube. There's a lot of misinformation just in general, people spreading around information that isn't correct. And I want to correct it. For instance, one of those things that is incorrect is that low interest rates drive house prices higher. That is, in fact, a wrong statement. A correct statement, which is positively correlated with data from history, is that house prices actually go up when interest rates go up. It is the exact opposite, and it's positively correlated. Remember, it's a loose correlation. This isn't like if this goes up, then that goes down, or if this goes up, this goes up. They're loose. It means in general with an R squared value, and I think if they have it in here, generally when things go up, when they go down, I'll show you that data. So I've got some data behind me. We're going to go over. This is what everyone focuses on for the most part. This is the Case-Shiller U.S. National Home Price Index. And they look at this last bubble when we had a whole bunch of inventory, a whole bunch of foreclosures, and a lot of problems, mainly driven by loans that should have never been loaned. We came up and we had 10 months of inventory right here. And I'll show you in the next slide what inventory does to prices at certain levels. But we overbuilt. We were in an expansion phase of real estate, and we had too much inventory, and we had a bunch of foreclosures come on. That drove house prices a lot lower. Now, this time up here does not have the same market conditions as this does here. This here is more like down here. We're going into an expansion phase of real estate somewhere in here. So this is analogous to the 1998 1999 area that we're about to go up. So this is probably going to go up quite a bit. Now, that doesn't mean that we can't have a short-term problem. If moratoria ends and something happens and more homes come on, we could see a little blip or dip, however you want to say it, in the short term. But structurally, we need to build more homes. It's got to come. But this is what everyone's focusing on. They're looking at this price. And then they create all these fictitious narratives in their head of why we are going to crash. They don't actually use any data. They don't use anything like logic. You know, logic is something that's good to use. That's going to help you out. And they just make up these things like unemployment's high. It's like, well, I mean, why is inventory at 2.4 months right now? Unemployment, if it's so high and nobody can afford a house, then, well, actually, if house prices are so high, why don't we look at the affordability? And I'm going to show you some pretty interesting data here. So this is the Case-Shiller U.S. Price Index. This is what everyone's focusing on. We've got a clear break of the old-time highs. It's running. We are in a strong uptrend. Inventories are low, and I'll show you all that in the next slides here. So the next slide here, what I'm showing you is the housing months of inventory versus house price. And on the left is existing home sales in months of supply. On the bottom is when it goes below a certain months of inventory, and the clear cutoff is 6 months. 6 months, we've never had decreasing home prices going under 6 months ever. They've always been increasing home prices under 6 months. We went under two months of inventory, and that's why you saw such a large increase in house prices, because we had no inventory. This inventory is going to have to go all the way up above 6 to for surely go down a little bit. If we go above 6, we might see a 0.5% decline up to 1% decline between 6 and 8 months of inventory. We have to get way up into the 8 to 12 months of inventory to start seeing more of a 1.5% decline per year of months of inventory. And that's a substantial move from where we are today. And I did a calculation about 1 month of inventory is 436,000 homes. it's estimated that the moratoria ending is about 200,000. So we would go from, if it's at 2.5, we would go to 3 months. So we would be in this area of strongest home price appreciation that the nation has seen still. That's the data that I have and have gathered. So all those moratoria forbearance guys, the data that I've seen isn't even going to push us to 6 months. It'll keep us around the 3-4 months range is what I've seen. Maybe the data I got was wrong, but that's what I've seen. So it is going to be game on if we stay under 6 months. That's the line in the sand. And if you go above 6 to 8 months, it's basically a neutral market. No price appreciation or depreciation. Now here's home ownership rate for the United States. I've seen some people talking about this saying, we're at all-time lows. We're right in the middle, guys. We're not at all-time lows. We were almost at all-time highs, which is not a good thing. You want it to be like in 2016 here, you want it to be increasing from an undervalued or from an under-owned, a low home ownership rate and moving higher, which means demand for homes is gaining rapidly. So we are at 65.5, which is really an average if you were to look at all the way back here. So we are not at lows and we are not at highs. We're right around the average, I would say, for home ownership rate. Next is the median sales price of houses sold for the United States. It is up there. It is moving on up, and we are in an uptrend. Nothing bad about this uptrend. I wish my portfolio looked like this, where it would just go up steadily like this the entire time. Now here's household debt service payments as a percent of disposable personal income. Look at that. We are at all-time lows, which means that the debt service payments have never been lower, which means homes have never been more affordable as a percent of disposable personal income. How is that possible? Are you guys being fed lies? So we have a middle home ownership rate. We have the easiest time in history to buy a house for anyone since 70, probably 75 or 80, wherever that begins, probably 1980. It's never been easier. It's never been better to buy a house. Here is existing home sales and housing inventory real time. We're at about 1.15 million. It's about 2.5 months of supply. It's at a very low inventory for existing home sales. Very low. Now, when looking back, this is the existing homes inventory and then the new homes. New homes ramped up, is basically ramping up a little bit while the existing home sales were getting eaten up and declining. And we've declined all the way down to about 2.5 months is where we're at today. This is a little bit older, but I'm just showing you the relationship of what's going on. And here's new homes. They built like heck from 2005 all the way to 2009. They ramped the new home sales up. They were building like mad, and existing homes were going up at the same time, creating a massive bubble in residential real estate for single-family homes. Here is the number of existing homes listed for sale. You can see that they have been declining. Basically, it's another way of looking at inventory. And when you have a large number of buyers and not many sellers, you're obviously in a seller's market, and your number of existing homes is going to decline, which means you're going to rely more on new homes being built. So we're in an expansion phase of real estate for sure. Now here's the housing index versus interest rates. This is just looking at the long rate versus the home price index. This increased all throughout this increasing interest rate environment. It also increased a little bit and went sideways during this declining interest rate environment. Then it really took off from the 1940s all the way to 1990 in a massive increasing interest rate environment. The largest increases in history occurred during an increasing interest rate environment in the 1970s. We had a massive housing market appreciation boom. At the same time, we had interest rates going through the roof. Then they lowered interest rates over time. We had another bubble within that one. And then we had a decline where interest rates also declined right through here. So this is something I'm going to read. It says, will someone please tell me if interest rates matter for home prices? Conventional wisdom holds that low rates mean higher home prices, while high rates have the opposite effect. At first glance, this is one of those things that makes perfect sense. The same mortgage payment translates to a larger loan value when rates are low. But how does this hold up under statistical scrutiny? The answer shocked me. They don't. In fact, history shows the exact opposite is true. Home prices tend to go up with interest rates. You guys got to subscribe to Finding Value because he's been saying this the entire time. Here's the data, all right? Here, let me get a little bit bigger. So this is the change in house prices versus change in rates. And you can see that it's kind of just scattered all over. But it has a positive correlation moving slightly higher, which means that home prices prefer an environment that has increasing interest rates. And you'd say, why is that? Because under an inflationary environment in an expansion phase of real estate, home prices go up, as does interest rates. The supply-demand imbalance causes inflation and higher interest rates, which then says that it is the driver, real estate's the driver of the move. Because if affordability was the driver, then you would see exactly what everyone thinks, which is lower rates drive home prices higher. But that's completely opposite. That's a false statement. It's not true. What you see is that the supply-demand imbalance drives home prices higher, creating the conditions for higher interest rates. And this is the data to support it, if you look at a statistical approach in history. And it says the scatter plot looks horrible, showing no relationship between changes in home prices versus changes in interest rates. Even stranger, the data shows positive correlation. Once again, conventional wisdom stands at odds with reality. So it's a very loose correlation, but it's positively correlated to higher rates and higher home prices. I just wanted to share this with everybody because I know everyone goes off the deep end. They say higher rates is going to ruin the housing market. In the past, it's actually shown that it's strong. That housing market prices go up with interest rates, that they're correlated. It means that we are in the right spot at the right time. So I wanted to share all this data with everybody. Now you kind of know where the inventory. I was reading some stuff in the comment section, and I think someone said, what should we look at? Should we look at unemployment? Should we look at what data should we look at to ensure that the housing market's going to go up? You need to look at basically two things. That's it. Just two things. Inventory, days on the market, and prices. You could do three. Prices, days on the market, and inventory. If you see inventory starting to go above the 6 months, that's when things will start to cool off. If it stays below 6 months, it's game on. We're in a positive price environment where they're going to continue to go up in price, house prices that is, if inventory remains below 6 months. If it blows through 6 months, you're going to see house prices start to decline, and if there's a good momentum going up, that might be a good time to maybe even scale back some of your positions. So I wanted to go over this. I know I saw a bunch of questions, and I wanted to make sure that everyone understands what I understand. So if you guys like this content, give me a thumbs up. Leave comments below if you guys have any questions, and thank you for listening. This is Finding Value.